Alright everyone, Cowboy Trades here and welcome back to the channel for another update on the stock market. So the markets are absolutely nuking right now. Here's what you need to know, here are the next price targets to keep your eyes on, and also a few signs that a new bull run is coming. Unfortunately for the bulls, this is a bull run in the VIX and not in the S&P 500 though. So diving into our first chart, we discussed this on the channel. This is a 5-wave asymmetrical triangle pattern, which is typically a continuation pattern depending on what side you break into it. Now, as you can see, we had a bearish 5-wave count into a 5-wave asymmetrical triangle. We had a throw over. We warned you on the channel that this was a fake out and we were going to continue breaking back down to the downside. And as you can see, we now have a red-green-red formation with a nasty bearish engulfing candle following up from what happened yesterday. So the markets are not looking good whatsoever. We're basically melting through all support levels for the S&P 500, and even if you don't want to make it as complicated as Elliott wave theory, even if you're just a fan of trend lines and you don't want to look at anything else, you can see that we've clearly broken through support from this level. And also, if we are looking at this bear market resistance that we had a throw over of, the most important trend lines are now violated as we are heading down. Moving on to our next chart. What are my price targets? Well, I'm going to keep it very simple. There are two price targets I've got my eyes on right now. The first one is this 618 Fibonacci from the swing low up to the swing high. This will yield us a price target for the SPX down at 3,758, meaning from where we are right now, this should be about another 3.4% drop. Now, considering how yesterday alone we literally melted down about 2%, this is not too far away. So let's talk about a nastier price target. If we come over to the daily time frame, actually, you can see over on the 14th of October, we closed a candle down at 3,584 on a Friday, and on Monday, we gapped all the way up to 3,640. So we have a price gap to fill all the way to the downside here at 3,548. This is where I think the S&P 500 is coming down to. This is almost an 8% move, a 7.88% move, once again down to my price target at 3,840. At that point, you can see, I mean, look at this. If we come down to this price target, we've only got, two candle body closes holding us up from new lows. We do not really have data traded beneath this big price gap to the downside over here. So at which point I do think we will be heading down to new lows, potentially the 1.236 Fibonacci at 3,323. This is a price target for another day. Let's come down and fill the gap first. This would be almost a 15% move. So in my opinion, wouldn't be happening anytime soon. I think we need to keep our eyes on these first two, being the 618 and the price gap. So now moving on from this chart, my price targets. And also just quickly, every exchange that we go through, bear in mind the price target of the trend line is slightly different on all exchanges, but literally for all of these exchanges now, we are absolutely melting through these macro trend lines. Now, quite recently on the channel, we talked about corporate insiders selling. You can see this over on the insiders transaction ratio, and you can see these three major spikes in the market, which we highlighted over here, highlighted over here, and highlighted over here. We gave you a warning sign when we saw that corporate insiders were selling, and since then we have been melting to the downside. Once again, another chart over on Blackball where we are melting through this trend line. In the past week or so, we've started to see increased transactional volume with lots of sellers stepping into the market, and you can actually see that the insider transaction ratio once again is pushing into bearish territory. Now, this is not a major spike. I'm really not saying that this small spike in the insider transaction ratio is something noteworthy. What I will be saying though is that historically, once insiders have started to sell, we proceeded to see 20.5% drops in the market. From here, we saw 14% drops in the market. From when they quite recently sold, we only saw a 7% drop. So even if we're going with the conservative range, dropping another 14%, you can see the S&P 500 down at 3,596 rather, which is literally right above our price gap price target. So That being said, like I said, insiders are not selling at a huge rate right now. They are starting to sell again. I will keep you up to date if they do start selling even more, but we're starting to see that volume step back into the market as we are breaking down. In terms of the oscillators right now on the weekly time frame, why I think we can come down to these price targets is because we've got a little bit of room to move to the downside on the stochastic. We're still at 42. Bear in mind, most of the time when this breaks down, this drops at 5, this drops down to 0, this drops down to 2, this drops down to over here, this was 7, so lots of room still to move down over on the stochastic before a bounce would be expected. The squeeze momentum indicator has not yet moved into bearish territory, and you can see a lot of the time, like over here where we had these big fake outs. Right now, we quite recently just had a big fake out where we were very overextended. You can see that the squeeze momentum indicator, once it moved into light red, it proceeded to have absolute meltdown effects in the market. We could be seeing something like this again if we do reset back to the heartline and push bearish one more time. And if we are looking at the MFI right now, we are coming into relatively oversold territory. I mean, bear in mind we're at 41 right now. We do have a lot of room to move down before we are going to be seeing a bounce in the markets. And the daily time frame is pretty much the same. I do obviously think, we can't keep on melting to the downside like this for the S&P 500 day after day after day after day. So I think it's very likely, especially if we come over to the daily time frame, we could see a bounce in the next few days or so. I think we're going to come down to the 0.5 Fibonacci at 3,843, proceed to see a bounce potentially up to 3,917, and this is going to be another crucial retest of this important trend line which we have been discussing on the channel. And you can also see, while we are on the topic of this, I have noticed another pattern. You can see the neckline right here is this important macro trend line we've been discussing on the channel. We also do have a beautiful head and shoulders pattern with a price target all the way down at the 618 Fibonacci, a price target that we mentioned at the start of the video, 3,760. So something to keep your eyes on. But like I said, oscillators, whether you're looking at the daily, whether you're looking at the weekly, they've still got more room to move to the downside. Now, if we move on to the liquidity in the market, checking out the book depth for the E-mini futures for the S&P 500, quite recently we just saw this absolutely monumental overextension in liquidity. We saw a huge jump in bids, we saw a huge jump in asks. The last time we saw a parabola run up in terms of the bid and ask spread was right over here. You can see, boom. This was one of the largest tops in the S&P 500. If we're looking at the mid price, this more or less tracks the S&P 500. And you can see liquidity tops we have marked over on this chart over here. So the tops in liquidity, top, 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 top. We've marked these with these blue vertical lines on the S&P 500. Once again, we just talked about this at the start of the video, but you can see this uptrending line of support's been violated. This downtrending line of resistance has once again been violated. And in a recent S&P 500 video, we talked about what happens after these liquidity tops. We break down, have a buyback, retest the 618 and break back down lower. Over here, we broke down, had a buyback almost to the 0.5, broke down lower. Over here, broke down, had a buyback, retested the 0.5, broke lower. Over here, we broke down, had a buyback, retested the exact top at the 1 level for the Fibonacci, broke back down lower. And quite recently, if we come over to the daily, you can see we had almost a beautiful retest just between the 618 Fibonacci and the 0.5. So once again, liquidity top, break down, buyback into the golden ratio, and break down into new lows, just like clockwork. So those are the main S&P 500 charts I wanted to update you on today. We are also seeing the DXY, the dollar, at a very critical range. If we do zoom out, you can see we've recently been on this bump and run pattern, and we're currently retesting this trend line and seeing how we're reacting to it. We are at a very crucial level. Zooming out, we have bounced from this blue box, which has been resistance since 2016, resistance in 2020, and we quite recently flipped it as support. Excuse the smiley face on the chart. But nonetheless, we are sitting at this trend line right now. I'll keep you up to date on the DXY. I personally haven't been looking at the DXY as much as I've been looking at government bonds. The main reason for that is because the DXY is really good when every other country in the world is not raising their rates. Understanding the strength of the US dollar is important, but if the US dollar is going up because the interest rates are going up, but then every country in Europe is raising their interest rates, and then also every other country across the world is raising their interest rates, then the DXY doesn't move too much because everyone is currently strengthening their currencies by raising the interest rate. So the DXY has more or less been doing a whole lot of nothing for the past year or so since everyone started raising rates, which is why I personally have been tracking government bonds far frequently on the channel. If we do look at the S&P 500, these have been beautifully tracking the inverse of what the S&P 500 has been doing, or rather the S&P 500 has been following what the government bonds have been doing. Now, you did quite recently see a huge breakout on the 10-year. It looks like we're coming back down to back test this before pushing up further. The US government bonds on a 2-year yield, they quite recently pushed up and made new highs. They came up to the 1.236 Fibonacci level. So if we are looking at kind of potential support levels that we could find ourselves coming down to, we do have a beautiful 618 right down here coming into confluence with the previous 0.5 fib. So around about 4.42%, which is maybe another 4% drop or so. So maybe another day or two of downward momentum for the government bonds. That may relate to a bounce coming for the S&P 500 on Monday, a slight buyback before, of course, continuing the trend for all of these. So bond market back up, S&P 500 back down. DXY, like I said, not looking at it as much as I am government bonds. The TIP ETF hasn't done too much in the past week, but it is kind of lollygagging at these lower regions. It is looking pretty ugly right now. Some people may be looking at this as a W pattern. I kind of just see us getting battered against this trend line right now, and I do think it's possible that we do come up to the top of this range before one final meltdown to the downside, making the TIP ETF break down into new lows. Of course, the TIP ETF breaking down into new lows called for the S&P 500 to break down into new lows after it. So, that with all of that being said, that's pretty much all I've got for you. The yield curve broke down into new lows this week, had a slight buyback in the past couple of days, but it is looking absolutely disgusting. And like I said at the start of the video, I am seeing signs that a bull run is returning. However, I'm sorry, this is a bull run in terms of the VIX. This is not a bull run for the S&P 500. The VIX is absolutely exploding this week. Today, we've even got continuation after that huge bullish engulfing candle. In the past 48 hours, the VIX is up almost 30%. The VVIX in the past 48 hours is still blasting up 38%. You can see the S&P 500 is not enjoying this whatsoever, and the CBOE, implied correlation index, in the past 48 hours, this is up over 20%. So we're seeing a lot of these volatility charts telling us that volatility is returning to the markets. And in fact, I'm pretty sure we made a video literally titled that volatility is about to return to the markets in a major way. Yep, 2 weeks ago we warned about this. 2 weeks ago we also told you, because of a lot of these charts we were looking at, when we were looking at these roundabout here, we were telling you the markets are getting ready to nuke, and we are finally seeing that take place. So for today, my friends, that is all I've got. I normally make longer TA videos over on the S&P 500, but we've looked at quite a lot of these charts. We're finally seeing everything that we were talking about playing out. I kind of just want to sit back, relax, admire these charts, talk about, once again, the price targets that we've got our eyes on. 618 Fibonacci for the SPX down at 3,760. Price gap down here at 3,580, at which point I think we'll be breaking down into new lows. Let's talk about more precise price targets for new lows another day. For today, my friends, that's all I've got. As always, if you do enjoy my content, let me know down below by leaving a like and a comment, share the videos with your friends, and if you want more of my posts, charts, memes, and economic data, follow me over on Twitter at 618_cowboy. For today, like I said, all I've got. It's been your boy Cowboy Trades. I'm out. Peace.